Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining us this afternoon, we have Mike Khouw, CNBC contributor and YieldMax strategist at YieldMax ETFs, as well as Luke Rahbari, CEO of Equity Armor Investments. We're here to discuss if the market is underpricing risk. It is great to see the both of you, as always. And really the question, Luke, volatility isn't acting as it normally would. We have Venezuela. We have some domestic issues here. U.S. jobs report was a bit sluggish. Market seems to be digesting it pretty well.
Yeah, it really is. I was on a call last night, and one of the clients was discussing all the hot spots in the world, and I was wondering where the cool spots were, because there's a lot of stuff going around the world, and um, the volatility I think is muted. I think the vol of vol is a little higher than the actual notional of vol, meaning there is some back and forth in the market, but the level of the VIX and the level of volatility is still a little bit on the low side. I would have thought, and I'm interested to hear what Mike's got to say, that we'd be trading somewhere around the 18 to 22 range, sometimes pushing 24 on some of the news and then coming back down. I am surprised that we're this low. Having said that, asset prices have gone up on some of this news, not only on oil, but definitely on commodities, metals. And when the market goes up, volatility tends to go down. But we are seeing some decent back and forth.
Yeah. So, Mike, let's expand upon that a little bit more in the parts of the market that are pricing in these geopolitical risks and the job signals more clearly, or is it bifurcated where the market is not taking signals from what we're seeing from a geopolitical perspective?
Well, I guess the first thing I would say, Luke was talking about how some of the commodities are exhibiting slightly different volatility behavior, perhaps than equities and maybe the fixed income world are. There is going to be some increases in volatility that typically accompany increases in commodity prices. So, for example, if we start seeing a circumstance where, precious metals, which have had a heck of a run, if you see higher volatility in that area, that actually is much more normal. So, and you can imagine why that would be the case. Big spikes in commodity prices usually accompany some other kind of a macro concern. If it is a consumable commodity like oil, that could reflect a supply-demand imbalance. And in the case of something like silver or gold, platinum or other metals, the circumstance there could be that there's continued concerns about debasement and stuff like that. I will say, it's interesting. I was on a trader call this morning with a big team of traders, and one of them made a comment. He said, perhaps in the Trump world, we just have to buy every single dip. It seems like it's an accommodative Fed. They said, that the president seems to be focusing very much on the equity markets as a barometer of his performance. He loves to tout it when things are going well. And that means that there will tend to be a little bit backpedaling. The other thing I've noticed is that it seems like the concerns about tariffs. So we've got obviously the Supreme Court decision. That's a big contributor in theory to volatility. But two things have happened, and that is that the huge concerns that happened last April, I think people recognize that some of those wild numbers that first came out were largely a negotiating tactic. And so the concerns about that impact have been more muted. And then on the flip side, let's say the Supreme Court says, okay, yeah, you can't do this. The administration has indicated that they have other levers. It's unclear what those levers are, but if they believe that they can essentially put into effect what they have already done by other means, then that would also mute its potential impact on equities, because basically they're saying, it's a difference without a difference.
Yeah. Well, I mean, what the trader had mentioned to you this morning certainly makes sense. Trump 1.0, he was very clear about benchmarking his performance, the administration's performance against the market. So I wouldn't see why you wouldn't expect that the second time around. I think perhaps another reason we're seeing muted volatility, Mike, is we're getting that sector rotation and the broadening out of the market to the other 493 stocks in the S&P that investors have been looking for the past couple of years.
Yeah, 100%. It's interesting. There's some sectors of the market that I had been looking at because obviously nobody needs to hear about the AI trade anymore. I mean, that basically has been it's been the talk of the town for the last 24 months. The question was, are we going to start seeing, the benefits in theory extend to other stocks. And we have seen that. We've seen energy names perform a little bit better, even as oil prices have been a bit weak. Things like engineering, construction, and procurement, that's another area that has basically been dead money for a couple of years, and it seems to be picking up a little bit of steam. So as long as the broad market is holding above, the long on or about the long-term moving averages, even as some of the leading trades aren't necessarily keeping pace to their prior growth, if we are seeing catch up in some of these sort of left for dead sectors of the past, I think that's a good thing. The other point that I would make is that, we've had a big rally, but believe it or not, as a multiple of forward earnings, the market is actually not more expensive than it was a year ago.
Yeah, that's an excellent point, and it's something that we've discussed wrapping up 2025 as well. Luke, the question is this rotation sustainable, though?
Yeah, I think it is. And as Mike said, there's been a lot of money that's gone into the whole AI thing, the chip sector, et cetera. And we've started to look at, so if there's going to be this big AI buildup and you already own all the Nasdaq names, the big Nasdaq names that NVIDIA, AMAT, AMD, whether you want to or not, because there's such a big percentage of the market, right? Both the S&P and the Nasdaq. I mean, a couple of years ago, if you took the Nasdaq names out of the S&P index, the S&P would have been flat to down. Okay, so if you think you own an S&P fund or a Nasdaq fund, you're really owning the same stocks. What's happening now is you're starting to rotate out of them, and like many other people have said, for us, and we're doing this in the fund, and just as a disclosure, we own some of these names. We want to go a layer below. Is this AI build out really going to happen? Well, then I'd rather own Caterpillar or some of the engineering names that Mike talked about. Is the infrastructure stuff going to happen? You need a lot of infrastructure. You need the power grid, all the stuff that We want to get into heavy machinery, also Deere. It's just not for farming, Deere and Caterpillar. And some of the other names, and maybe look at some of the utilities, and then look at the energy companies that, believe it or not, are starting to look at solar, are starting to look at nuclear. I'm talking about oil companies now, and starting to move in that sector. And I think it's a good rotation for us because I trust that if ExxonMobil wants to get into nuclear, they're going to figure it out with a lot more money and a lot more power than maybe some startup name or a secondary name. And by the way, if it doesn't work out, you still got the oil, you still got the reserves, and that seems to be going pretty well. So the rotation is a little bit of risk management, but it also makes sense on a macro environment.
Yeah, and Luke, it's interesting. We spoke about this on a panel earlier this week at MarketSite, that it's not about the technology at this point with AI. It's about how senior leadership is deciding where they're going to extract that value from. The workforce, the cultural mindset, the security aspects of it. So it's no longer, okay, let's integrate this technology. Now, how are we going to use it, and how is that going to translate into ROI? And I think that's really what the conversation is going to be for 2026 for sure, and leading into 2027, because you have to justify these investments at some point.
Yeah, and the other thing I would add is it really, and I really don't have a good handle, and I'm trying to find out, but I don't have a good handle on the Chinese chip sector, right? And some of their AI models. They make announcements, they make big noise, stocks move, but are they really delivering? Are they really not? I'm not ICE. We still haven't figured it out. We're trying to. But I will tell you this, if you have a chip that's half as slow as someone else's, as long as you can drive power to that chip, you're going to win. So it doesn't matter if you have a big pile of chips and you can't get electricity to your center, right? So I just think, again, I'd rather try to figure out the piping right now rather than who's got the best model or not, and then worry about that a couple of years down the line.
Yeah, and that goes back to the point that you made with multiple sources of energy resources.
Right.
Yeah. So, Mike, is there anything we can discern from earnings at this point? I mean, we're not that far into 2026, obviously, but is there anything that you could tell that is reflective of your outlook from a fundamental perspective for 2026?
Yeah, there's two things that as you point out, we the quarterly earnings season, it's not even really upon us, right? It begins with the financials. We've got JP Morgan and names like that to focus on, but we're just starting, so we're about to find out. What I will say is that one of the things you can take a look at are things like alternative data on the retail side. What's the state of the consumer? I like to look at things like Placer AI and things like that, just to see what is the foot traffic looking like. And those numbers actually, in some cases, have been looking pretty good. I've actually also thought that there are names that have been very severely beaten up in that space, in the consumer discretionary space, for example, that might actually start to look attractive. I'm thinking of names like Lululemon and things like that. This is a name that's now trading at a very cheap multiple. It seems like the foot traffic has actually picked up. Now, there are other reasons for that, because there's a lot of cross currents. For example, American Express, which is a name I generally like, they also have totally revamped their incentives for their like platinum card holders and so on. They have quarterly incentives to go into Lululemon. You can't walk into a Lululemon, walk out with a bag, and spend the $75 that they give you. So I have a feeling this is going to have a profound impact. And I will tell you, this is anecdotal. And Hawaii, which is where I was for Christmas, is probably not the best. It's probably not the best litmus test overall. But I can tell you, I haven't seen stores as busy as they were while I was there in a decade, I don't think. I mean, it was absolute mayhem leading into Christmas and even immediately following it. I hope that's true, that consumers are feeling better, because it is a 70% consumer-driven economy.
Yeah, I would agree with you. Certainly services and, to your point, retail is really busy this year. I mean, in certain circumstances, I thought even prior to COVID, and we work in Times Square, and that's as busy as it gets. And it felt as if it was even busier there than it was pre-COVID. That's for sure. I wonder, Mike, if because there's more sources of capital for consumers, such as BNPL, as an example, that they're able to extend their spending. I would also imagine because of certain tax benefits that are for 2026 that people are going to see reflective in their returns, if that could also be a tailwind for the consumer as well.
Yeah, I mean, Treasury Secretary Bassett has specifically said that people can anticipate much bigger tax refunds if people are already baking that into their cake, if they're using things like TurboTax and estimating what their refund's going to look like, and that's factoring into consumer spending. That could be a profound tailwind. It's interesting because, and I think you and I talked about this a couple of months before the holiday season, that surveys had suggested that the average household was going to spend less. I don't think that's going to turn out to be the case. I have a feeling it's actually going to come in. I think the survey was $100 less for 2025 than the previous holiday season in 2024. My guess is it's going to come out on the high side. I think that's going to be a meaningful positive surprise.
Yeah, I agree as well. Appreciate both of your insights as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.